you have to be willing to get in and out. And he goes, I think that if you're a good investor these days, you look at everything as a trade.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I am joined, as always, by the brain trust himself, Mr. Chase Taylor. And I will admit, I'm a little bit out of practice. I got off a plane this morning at about 8:30. I was defending our company's honor at a golf tournament and didn't play all that well. Chase, I know you've spent a lot of time on a golf course. But it was
all of it before I was 20, but yes.
I don't know if this means anything to you, but for reference out there, I'm a 7 handicap, so I'm a decent golfer, long ways from scratch. But this kind of surmises my whole weekend. So yesterday I shoot an 85. Now, meanwhile, I'm one of the youngest guys there, 43 years old. This is mostly like a 55 to 60-year-old guys kind of deal. And so me and my playing partner were two of the longest guys there, by default. And so what that means in golf, when you're playing, when you hit it 280, 290 off the tee and all the guys you're playing with hit it 200, that's a huge advantage, right? And you should own the par fives. So I shot an 85 and I was 7 over on 3 par fives.
Oof, yeah.
Yeah. So it was not a weekend to remember as far as scoring goes. There was some I was striking the ball well, just couldn't convert on the scoring side.
So the question when it comes to Reno is, did you get the $3.99 steak and eggs?
I didn't. We missed that.
Yeah.
We missed the $3.99 steak and eggs. And you know what? I bet you could probably still find a $3.99 steak and eggs there.
I don't doubt it.
Yeah. No, I was not too up on the Reno nightlife. So I think the latest we were back to our room was like 7. Like
not much Reno.
No. By the time we were done, we'd order a pizza from the place downstairs. I'd get 4 liters of water, and I just wanted to go sit on the bed and watch, just watch Sports Center or something like that. So I'm not a gambler. I think I've told you about that before too. See, casinos have always bored me. Anyway, so since I've been gone though, kind of more of the same. I don't see a lot of big noteworthy stuff, but do you want to give us a rundown the indexes?
Yeah. One thing popped out to me today there. Just one day though. S&P closed up 0.58, Q 7.8. The thing that popped out to me was small caps today up 1.6. So if that can keep up a little bit, that might be somewhat interesting. Maybe they can get themselves a nice little run. Equal weight was up 0.83, Mag 7 up 0.25. All world ex-US down 0.46, thanks to some dollar strength that especially hit Europe. You had oil up another 1.4 today, gas up a little bit, gold down about 0.6. Some of this will have after hours in it too, because we recorded a little late today. Silver down a smidge, platinum up at about 0.7, palladium up another 3%. That's one that is jumping off the chart at the moment. The dollar up 0.53 on the day, and then you had 2-year yield up about 2. Same for, honestly, the whole curve was basically up 2 basis points.
On the gold front, I'm seeing something interesting, and so far it seemed to have some legs. And it's a really good sign when you're looking at previous gold runs. Pretty much every gold bull run I've ever seen or read about had these characteristics, but on a day like today, where for most of the session, gold was down right around 100 basis points, 1%, there were multiple, especially junior mining gold companies that were up on the day.
Yeah.
And up more than 100 basis points. That, to say that is, a break from the way things have worked over the last several years, I think that's an understatement. That just did not happen up until in the last 30 days, maybe, right? Yeah. What I think it is I think the market is starting to become aware of wait a second, miners aren't just a one-way metal trade. These things have an unbelievable amount of margin built into them, meaning gold could drop substantially from here and those miners would still be undervalued. It feels to me like the market's starting to pick up on that.
Yeah, and a chart that kind of shows it is if you look at the juniors versus the bigger miners, like you're teasing a massive breakout on the monthly chart there. So that's a big deal.
Huge. That's a huge deal. And there's a lot of price information in that, because what that typically signifies, and I haven't gone and looked at the data, I'm starting to hear rumors about it. What that tells me is that investment money is starting to work its way into miners. It tells me that junior miners out there in the exploration phase are starting to get some favorable terms. And we're talking about a market that's been on ice for the better part of 15 years, at least 12 or 13. Meaning there's nothing going on in that world for
right. Other than the COVID pop. Yeah. It's just been basically.
And that wasn't even really long enough to,
right.
that didn't have any impact operationally
right.
in any of those companies. That's really interesting. The other interesting thing to me is uranium. We haven't had a chance to really dig into this, but when Trump made his statement, I think the average uranium stock's up, 15 or 20% since Trump made that statement?
That's probably about right. Today we got Facebook or Meta did a big deal with Constellation that got us jacked today after, URNM had a 10% update the day of the executive order. So
yeah. What was there anything in that executive order that you think changed things as it relates to the average uranium miner over the next 12 months?
No. So this is a tough one. This is it's a really, really good executive order, but you have to balance it against some stuff. Executive orders don't fund things. Congress does.
Right.
And one of the problems is Congress, with the big, beautiful bill as constructed, it takes a lot of money away from nuclear through different subsidies and tax breaks, because they got rid of anything that was attached to anything green. It was like, well, let's get that out. And no one stopped to think, well, that also takes out a lot of
nuclear
funding, and whether that's just loan subsidies, things like that, that are getting pulled out. So now obviously the nuclear lobby and the pro-nuclear senators and stuff will probably take a hard look at that, and they might change the bill. What the executive order largely focused on was a lot of just regulatory reform of tightening up timelines, making environmental, that kind of stuff a lot easier. There's also some stuff in the bill that will take the workforce down in some of these important offices, and then the executive orders gives them more work to do. So it's you're kind of at competing weird ends there. So this one's tough. I'm excited about the executive order. It does a lot of good stuff. It even stretches the deregulation past what obviously what anybody expected, because you had the 10% update to the point of radiation levels, being more relaxed on some of that. So a very good one for the industry. But you talk to people in the industry, and a lot of them are it's nice, but
it's still a very slow moving ship. And I think that's what has made it really hard to play. And I think it's what it's made it really hard for the average investor to get their hands around. And not average investor, even professional investors. I just don't think they realize, for instance, people used to dealing with the energy industry, the nuclear, when you just start understanding the way those contracts are put together, right? You realize that this isn't anything like the oil industry. It's not going to move nearly as quick. These things take years.
Yeah. The construction projects alone they're these are big science experiments. So it takes a long time.
Are the length, the time required to build a nuclear plant, when I've heard it before, it is staggering. Is the majority of that due to the complexity of construction, or is it permitting?
All of it. It's both.
So even if you had the most, cooperative jurisdiction and local government, it's still a very arduous task.
It's one of those things where, the more you do it, if you keep doing the same way, the more you can keep shaving time at each iteration, which is one of the arguments for you. Let's just keep using the AP 1000 over and over. Let's get good at it. then we'll be able to bring that time in. And obviously you bring the time in, you bring the budget in. But you go back to like 70s and 80s when we were building a bunch, we got pretty good at it and got to where we could do them pretty quick, and for a reasonable price. And then we stopped for 25 years or whatever. And then when we went back to building it, like when we did the last Vogel one, like it took forever. It was way over budget, but that's because like we didn't have the workforce to know what they were doing anymore. You know, you run into a problem in the supply chain. There's like one guy named Ed that's like 80 that knows how to do it. Like real problems. Like, so, and that's where like, you know, you see China getting that big leg up on things like nuclear because they're building a bunch of them and they're graduating a bunch of nuclear engineers and stuff. You know,
I think that you're going to run into a similar issue in the metals mining arena.
Yeah.
And it'll catch people off guard when I say that. If you go look at the number of new mines that have been developed in the last 15 to 20 years, and you look at the reason why they haven't, and you look at how much of it is government regulation and all that kind of stuff, there's no talent left.
No,
nobody knows how to do it.
Yeah,
they know how to run a mine. They don't know how to get
right.
So one
they can do the spreadsheets, but
and I honestly think, and we've talked about this before, but I think everybody's experience with oil, especially over the last 5 years, has created some really interesting opportunities in other commodities because I feel like they've all been thrown in the same bucket.
Yeah.
Right. And what these people do not understand is that when you have a shortage in these other metals, you are not 6 to 8 months away from fixing that problem.
I mean, we're seeing it with the rare earth stuff speaking of China, like that's a genuine leverage point for them because, you know, we're kind of 5, 10, 15 years away from like really replicating what they're doing.
Well, and then everybody here in the US goes, yeah, but we've got plenty of it too. And I was having this conversation with a client the other day and I said, that's not the issue. We've got tons of it. The issue is you can't get it out of the ground.
Yeah. Everyone has a bunch of it. It's
just,
they're not that rare in real life, but getting out of the ground and then as importantly, you know, all the refining and processing of it, which is not a pleasant process. Like
that
stuff's expensive. It's difficult. It's hard to do profitably.
And you're getting pushback from every inch of the process, right? Any level of government you touch when you're opening up a new smelter, right? Or an autoclave or there is no branch of government that's happy to work with you on that, right? I mean, it's constant friction. And that's if you know what you're doing. I think it's going to be really interesting going forward just because there's so many of these industries that for a variety of reasons, especially here in the US, have just had massive brain. I mean, if you're a structural engineer, I can tell you the one place you're not working right now in the mining industry.
Yeah.
You know, you've gone to other places. And
yeah, to me, it's one of those things where like, of all the things we should be subsidizing, it probably should be like hard tech engineering, STEM type, you know, programs, and doing that at scale. Like the Colorado School of Mines should have everything they've ever wanted.
Yeah.
You know, and people should be able to go to school there for free if they're good enough to get in. Like it should be that intense, you know.
How is the Colorado School of Mines is a state run school, right?
I believe so.
Yeah. They're not a federal school like the.
No. Yeah. It's a private.
It is it is private.
Well, it may be attached to Colorado, but it's not federally anything.
It's not like the Navy or the Citadel. Yeah. I was thinking for a second it might have been one of those. What else have we seen? The lot of back and forth, lot of media drama surrounding Elon Musk and the big beautiful bill. I kind of think the drama is a little funny on that front because I think what Elon's saying is sort of obvious.
Yeah. I mean, Elon's right, but the problem is Elon probably cares more about all his subsidies getting canceled in that bill than anything.
Possibly, but at the other side of it too, like from a messaging standpoint, it's kind of confusing to me because I don't understand how you go in the course of 90 days. You go from we're going to cut $2 trillion off the deficit or off the budget. We're going to balance the budget in the next year to. We're actually going to increase the deficit by another 25%.
Yeah, there's been a lot of now maybe not from Elon because all the tech bros I just don't think they understood how this stuff worked, but I saw that a lot with really smart dudes. But with like in government, the people that should know, but everyone should know better, but they should especially know better. Like I just think it was disingenuous. Like from especially Bessent talking about a couple months ago, like, hey, Trump's asking me, like, what do we got to do to balance the budget next year? And it's like, okay, well, no one's done the math apparently. And I know Bessent's done the math, so it's just disingenuous to even talk about. Or, a couple of days ago when he literally said that year to date, we're tracking with a smaller deficit than last year. Not only is that literally wrong, it's wrong by like a lot. And that's just
how he must have based that on something. I mean, usually the biggest government shill can point to something and say, well, based on our CBOE projections here or whatever.
Yeah. Like, I don't know, because you can do that through, and it's one thing to say like, hey, this bill is going to end up being deficit neutral or something. Cause I think you can come up with some funny math to make that look right. But to say the current deficit is running at a certain level compared to last year, this is math. Like, yeah. And they publish the data. Like the agency he runs publishes the data and it says no. Like, I don't know.
Well, the other thing too is, look, I always understand why politicians lie or BS. Sure. I get that. And they're all sides are guilty. But I honestly think that Trump's election and his election twice, if nothing else, I think it points to the broader populace wanting to some degree a more honest exchange, a less polished.
Sure.
You know what I mean? Like they want it straight. And what I think is unfortunate is I think an opportunity is being missed here where we can actually have an honest conversation and we can sit down and go, look, we're going to get out of this the same way you make diamonds, man. It's going to take heat and pressure over time. Okay. And we can't cut 2 trillion like I wanted to, because here's why. The government's got entrenched in too many parts of the economy. And if we cut it that drastically, we're probably going to be looking at 7 or 8% unemployment. And truthfully, if you cut it that drastically, you'd probably be looking at a lot more than 7 or 8% unemployment.
10 plus. Yeah.
Yeah. Especially if you did it in a year.
Before you bottomed out. Yeah.
Yeah. Before you did it in a year. That's an 8. That amount is similar to like 8% of GDP. That's kind of a big deal.
There's no slash in the budget without blowing a hole in the economy. There's just not.
So there's a part of me that I am sure that the Trump administration, I'm sure there were genuine parts of them that thought they'd be able to cut more aggressively. And it kind of reminds me of the Yellen-Bernanke or the Yellen-Powell when we were talking about the Fed, right? Oh, the Fed screwed it up. Okay, well, now you're in the position. Here are your choices. What are you going to do? And I think, unfortunately, this is why our debt keeps spiraling out of control, because all these politicians realize if I do what needs to be done for the debt, I'm done. Right?
I mean, so yeah, like all the money is in Medicare, Medicaid, Social Security, defense, and interest.
And that's like when we say all the money, that's like 90%.
Yeah,
isn't it?
Like the rest is just it's borderline meaningless. Mm-hmm. And the rest has some really important stuff in it. So it's not like you can just cut it all to zero. But you can literally cut the rest to zero and you're still running a deficit. And the tough part is like if you project it all forward, it's nasty. Like, I mean, look at the demographics, how many people retire every year. And on net, more people are adding into drawing from Social Security every year. So like that literally is going to get bigger. Same for Medicare, obviously. They're doing the cuts to Medicaid in the bill as constructed now, even though, they're saying like, oh, like it's going to be fine. This is just like fraud and waste. The reality is a lot of people are going to get booted off of Medicaid. That's how they're going to save a lot of the money and making the states pay more. So like the reality is like, we all have to have an adult conversation about things like Social Security and Medicare and DOD spending, like which they ramped up significantly. So,
part of me wonders, and again, there's going to be 18 million ways this could fail because it's government, and I understand that. But part of me wonders if if a potential road forward to more responsible and more effective governance would be federal money doled out to states, right? So almost the states are put on allowance. Because remember, the states have a firewall that they have to contend with that the feds don't, which the states can't print.
Right.
Right. And I feel like there's a way to structure that relationship that would incentivize both sides of that deal to be more conscientious about what they're spending. Do you see what I'm saying? Like put more of it, do it in a way where you're not hamstringing the states, but put more of it off on them, compensate them by offsetting that with cuts or, extra help over here, but kind of sitting there saying, okay, look, this is what you're going to get. You got to make it work. You know what I mean? Where, because we've got to start getting, you got to address this debt issue on so many different fronts, but first and foremost is government efficiency. Especially, ironically, it might be worse at the state level. Like, meaning, especially when those states are getting awarded federal funds for things, just when you think about some of the most egregious, like ridiculous spends, it usually is coming from the state government, the ones that hit the news, right? You've got somebody's like, oh, Iraq and Afghanistan. No, I know, I realize it. But I'm talking like domestic policies type stuff, right? Like I'm reminded of, the micro houses that they built down in San Francisco that have just turned into a giant drug fueled market now because of just idiotic, stupid stuff that nobody would have done except the government bureaucracy. I see what's happened up in Seattle, how we were going to build these micro houses and they get a couple of them up and they cost over $1 million to build them, and every private developer that I know was sitting there going, we could have done that for $250,000 easily, So maybe passing some of that off on them. I don't know. Maybe there's something there. What else? What else you see in here? I'm not really. I'm looking at the markets right now, and this goes something that we've talked about many times. But it was funny when you were telling me about small caps rallying. I was sitting there looking around, thinking to myself, "Boy, I don't see anything out there that would get me really excited about small caps right now, especially not with rates where they're at."
In real life, no. But could I see a 6-week just ripper or something like that? Like,
sure.
But the Russell 2000 is basically a just truly terrible collection of equities. So it's not something you want to just buy and hold. But I found it interesting. Now it often has these one-off days and then they just kind of melt away.
Yeah.
But it was a big enough one where it's kind of like, interesting. Okay. Maybe they'll play a little catch up because they're, if you kind of chart them versus the rest of the indexes versus last 6 months, 18 months, whatever, it is bad.
Yeah.
So I can see them having a little, reversion back up and then go right back to being, a truly terrible index again.
What do we see on the international side? One of the surprise, you and I have talked about this before. I think we talked about it last week, but one of the things that has been a bit of a surprise for me is, especially with the ebullience that you've seen here in American markets, I would have expected Chinese tech to do better here.
Yeah, I think they've had a couple like earnings one-offs that have stung. That's been a big part of it. But I kind of agree. Like just whenever we had the trade situation kind of clear up a little bit, bringing the tariffs down from a bajillion to 30 or whatever. I thought they would do better than they have because they've been kind of a wounded duck since. But at the same time, those tariffs, and like we've talked about a little bit, like FXI the large cap Chinese equities have crushed the internet stuff in the last like month or two. If you think about that, it kind of makes sense. Like it's not like we were really tariffing their internet companies and their tech companies because we weren't doing business with them anyway. So pulling the tariffs didn't help them. And you think about the companies that actually export stuff, they're going to be in FXI, not in KWeb for the ticker symbols. So in that way, it kind of makes sense. I think you had the AI hype train like really ramp a lot of that stuff, and I think you're just kind of in the digestion period of some of that. But I think they're going to be fine though.
Something. This is more like a PSA, but I've had multiple conversations of this, and doing what we do and being surrounded by it all the time, it's easy to lose sight of this kind of stuff. But the evaluations, and I want people to understand what I'm talking about. So we did a town hall meeting and one of my clients asked me a really good question and it kind of cued me off. And I went, and for those of you who don't know, most of our clients do not speak to me individually. We've got about 1,800 clients. Obviously the ones that have been with us the longer are my individual clients, but chances are your advisor is somebody other than me at our firm. So these town hall meetings are a chance for me to talk to everybody directly. And it's great because you get great feedback and great questions that always spur, other ideas and other research projects and things like this. But being a client of our firm, you're hearing us talk about fundamentals and valuations way more than anybody else is. And so when one of our clients asked this question, I was reminded about, it's really important to explain to people what we mean when we say overvalued, right? And we were talking about Costco specifically, and his question was, he responded, and he was exactly right. I went and checked his math. And he said, I don't really get what you're saying about Costco. The total shareholder return the last 2 years has been 28% per annum. And I went, yes, that is what has happened in the past, but we do not buy stocks because of what they have done, right? When you bought that company, and if you realize that appreciation in shares, and share prices, you bought that company when it was trading at 28 to 30 times earnings. It's now double that, and its growth rate is smaller than when you bought it. Its margins are smaller than when you bought it, not by a lot, but by a little. And now you've got a company that's trading at 60 times earnings, that's growing 5.5% or in line with the market, right? Market average is about 5.5% revenue growth. They're growing at 5.5%, but the average S&P 500 company's got about a 24% margin, not 2.7, right? And so explaining to them, look, total shareholder return is dividends plus stock appreciation over a period of time. What that means for a company that's paying a 0.5% dividend is that's all stock appreciation. So unless you think they're going to 120 times earnings over the next 3 years, you're going to be sorely disappointed.
Right.
And I don't think enough people understand that and realize what they're paying, right? Looking back and saying it's not overvalued because it's delivered 28% a year over the last year. That's why
it's overvalued.
That's right. That's exact. You're inverting. Yeah. And I'm not, and this client, he's a sharp guy. I'm not picking on him at all. Really like the guy. But just it's kind of almost like a PSA, right? Sitting there going, hey, guys, when we're saying this is too expensive, we're not. When you see a stock that's too expensive, somebody's made a lot of money on it.
Yeah, if it's become the poster child that we're going to, like the sign we're going to tap, it's crushed it.
Yeah, people have made a lot of money on it, 100%, right? Apple. I mean, think how much money's been made in investor accounts from that. But guys, here's the side of investing that nobody really wants to talk about. At some point, you got to sell them. What about Buffett? Yeah, what about Buffett? He sold 80% of his Apple, right? Like everything. I read another compelling thing the other day, and I thought about you, and I was going to send it to you, and I forgot because I was on a plane and I didn't have internet. Now I'm going to have to go back through my phone and try to find it. But it was a very and I'm forgetting, but a very intelligent investor that's got a very good track record. And he's known for being an investor. But he wrote, it was a fairly small missive, or maybe he was being quoted. Anyway, his whole point was eventually everything's a trade. And he goes, especially in the world we live in today, he goes, you can't buy an asset with confidence and know what that asset's going to be or even be close to 10 years from now. And he goes, it didn't used to be that way.
It's true. Yeah.
And he said, you have to be willing to get in and out. And he goes, I think that if you're a good investor these days, you look at everything as a trade. Now, do you want longer timeline for it? Yes. If you're a good investor, you should want as few as trades as possible.
Right. So the way I see it, like every trade you put on, you hope that it's something you own for a decade.
Yes.
But every trade you put on, you do it with with some risk in mind that like, okay, if it's below here, like something about it or about me is wrong here and I got to move on,
Or maybe you don't move on and you start using
it back on the watch list or whatever,
or maybe you just use it as a funding mechanism for the rest of the portfolio, right? Just every so often, just keep trimming more, letting it feed other stuff, right?
I'm reading a book right now from the 60s from a guy named Ted Warren, and he used the word investilator as like a mix of investor and speculator, which I kind of think of as a trader as. Yeah. And I think it's a good way to kind of blend, a blending of the two. If you think about, we always talk about Druck as like kind of for our money, kind of the best pound for pound investor.
Yeah.
Based on what he's done, and he's a bit of both. Like we were talking about Coupang today in our meeting. Like he's owned that thing since the IPO, So like the guy can be an investor and own some stuff for a long time that he believes in, but he also can jump into like 2-year treasury futures for 3 months, make a killing, get out, or jump into it for 3 days, decide he's wrong, get out. Like is that blending of two different disciplines essentially.
Yeah. And I think the technological advancements in the world and the markets
so fast.
Oh, well, I mean, you've got companies. I mean, stop and think about this for a second. You could do this with a bunch of companies, but Google, right? Like Google's a company and a bunch of the tech companies. Well, Facebook even. But Facebook got started in a dorm room in 99. So in the space of 25 years, you go from nothing to $2.5 trillion of market cap. You know what I mean? History's never seen companies that grow that big that fast.
Yeah, you look at OpenAI. I mean, it was like a nothing burger 4 years ago.
Yeah,
it was like,
most people didn't even know what it was.
4 years ago, right?
Yeah, and then, but the thing that I think everybody's got to keep in mind is anything that can grow up that fast can get smoked that fast.
I mean, I think about that with Apple. Like anyone that's dependent on like one big thing, you could say Google with search, although I think they'll be fine in other areas. But still, like anyone that has a lot of eggs in one basket in tech, in an environment where everything's getting disrupted in tech, it's like, man, these like behemoths that are just like such staples. Speaking of that book from the 60s, the guy uses like 1 million charts in it because he's a technical heavy guy. But then I've never heard of 95% of the stuff that's in there. And it makes you realize like 60 years on, almost none of this stuff exists. And back then this was like a staple of everyone's life, this company. And it's just gone. Like,
yeah.
And not only is it not around, I've never heard of almost any of them, So, and it'll be the same in 60 years. People will be like, oh yeah, I remember that company, and it's like, it's some powerhouse today that may not matter. Because the world's changing so fast.
No, I mean, some of them are stalwarts. I mean, like, for instance, our kids are going to own Dog Whiff Hat, right? I mean, there's going to be some stuff that stands.
Yeah, well, Whiff's going nowhere. But
what's that?
Whiff's going nowhere. That's a
Whiff. I love it. It's already do you still own some?
I do.
Did you? You bought it cheap though, right?
Yeah. It had a tiny little like short time frame breakout, and a friend made a kind of like poking fun at a tweet. About it because it's showing the kind of breakout, and he's like, this would be funny or something like that, or like if you're a real
degenerate,
like crypto degen, you're buying this, and I was like, mission accomplished, I did it.
I'm in. Sign me up. What else we got? You got anything else? We got data prints coming up this week.
Yes, a bunch. It's jobs week. Today we had job openings that were a good bit higher than expected. So we'll see how the rest of the jobs data goes the rest of the week, though.
I've never been one that's had any luck with JOLTS or job openings information. That is surprising to me, though, that you see, again, 1 week's of data.
And that one is often way different than people expect. So like, no one's good at forecasting that thing. So, but the jobs number this week is expected to be around 150. And I want to say people have the unemployment rate sticking where it was. And I feel like a broken record, but I don't know on the number, but I still think that the unemployment rate can actually tick higher.
How much are these data centers boosting GDP numbers? Mitigatable?
Not by much.
I don't see where what are we now casting at 4% right now? 4% growth?
Change, like 4.5-ish.
How?
So, and I talked about this. Remember in Q1, I said, hey, we're going to pop negative for Q1 GDP, but a lot of that's the net import thing.
Yeah.
And then that will flip itself Q2 where we consume our excess inventory, and that is a positive for GDP.
Yeah, right.
So basically just a giant plus up of inventory and then a drawdown of inventory, and those have a giant growth impact. But to be fair, it's not just that when you look at the current data. Like consumption is very strong in there. Government is very strong in there. Investment is very strong in there. So like, it's a strong number so far, but you're 1 month into the quarter. So
yeah,
or maybe 2.
I'm trying to think about where because I am just seeing it and hearing it from all corners of people that I'm talking to. Not bad, but just everybody feeling uncertain. Everybody talking about demand not being what it used to be. Interesting conversation with a couple of contractors over the weekend. Some of the guys that were on that trip, they were just saying that, like, look, the jobs are drying up and it's getting way more competitive, but they go, boy, it sure is easy to get subs now. So that construction picture, at least in this area, now all of them work in this area.
Right.
So, you don't want to extrapolate too much. Although I feel like this area is a pretty good litmus test for a lot of the country. There's going to be some pockets.
It can be a little geographically constrained in some pockets here.
Yeah.
Like you go back when I was back home in Texas, where it's just prairie in every direction, and you can just build at your heart's content. Like, you could tell they overbuilt in Houston, and you can see it now where I think they're going negative right now for prices. Florida's kind of like ugly negative for prices. Rents have been negative on a year-over-year basis for like 2.5 years now. So like that's positive for the consumer because people are still growing their wages 4% or whatever, and their rent is flat to down. So that lets people kind of catch up in that way. But the construction and just real estate in general, like that is still to me the economy's fine right now. Like it's not great, it's not terrible, it's just fine. Like I think growth's probably running right around trend at the moment in like a more stabilized way and not just looking at one quarter with all the noise in it. But I do still see that construction risk as being significant. Redfin had a chart that showed their estimate for how many people are buyers right now versus sellers. That is it's not a cute chart. Like it's blowing out. And around here, I've noticed inventory's exploded. We live on a little island, so it's easy to keep up with how many homes are for sale there.
Yeah. Yeah.
I remember some points it was like 2 or 3. Now it's like 15, So like
I drove down a street the other day. I kid you not. Half the houses. Yeah. It's not as bad as 0809. I'm not saying it is. Not making that comp. But I was just sitting there going, boy, I have not seen this in a really long time.
Really, it's just getting back to normal. But, like where my sister lives in West Palm Beach, it takes 81 days for the median for the home to sell right now.
Yeah, no, it feels kind of like a market that's gone no bid.
You know
what I'm saying? Like, I mean,
kind of has, yeah.
I don't think that the stated value. I think most of us walking around with a value in our minds for our house. I don't think you're far off. Like most homeowners, you're probably 5 to 7% high, right? If that's like most people. Okay, but and I think you probably get that price in most certain. But you're just gonna have to wait a while.
You have to wait, and you have to find the right buyer for your house. Like it's just
Yep. And what's scary to me, and again, I don't want to get too dark or hyperbolic, but what's scary to me is that when you have a setup like that, that's just kind of like a dry tinder scenario where that can turn to a rush to the exits really quick.
Yeah.
Now the anchor though you've got though is low rates. That's going to be something that probably keeps that from happening, I would think.
Yeah. If we got into a recessionary scenario where housing was a big problem, if, and it is important if long rates were able to come down enough, you'd be fine. Like you get down to the 5s in mortgage rates and housing will stabilize, no problem.
Well, you may even see scenarios where people lose their home, have to move out of their home and rent something and rent their existing house out.
Yeah.
You know what I mean? Because their mortgage
would do that.
Yeah. What'd you say?
Smart mortgage providers would do that, but
yeah. Or like Carvana, just renegotiate the loans. That stock just keeps moving up. That's hilarious.
One last thing, because I know we're kind of running a little bit long here. I was listening to the interview Grant and Dimitri did with his last name's Calamaris. So I always forget his first name. Basically, the guy that is sort of the authority on fiscal dominance, and he was talking about a little bit about like what we were just talking about. Now I'm going blank on exactly where I was going to go.
Well, hold on one second. Then. Yeah. So just to explain to people, when we say fiscal dominance, we're talking about when we enter scenarios where budgets and budget deficits and all that kind of stuff start making decisions for people, right?
Or the Fed. Where the Fed can't do things based on the mandate. They got to do things because, hey,
they don't have a choice.
There's a fire, we got to put it out.
Right. Like for instance, an example of fiscal dominance would be yield curve control or making 401ks buy so many bonds per year.
Yep. I forgot where I was going with that, but he made a point that I found really interesting along the lines we were just talking about, but now it escapes me. Well, it'll come back tomorrow.
Yeah, I was going to say it's fodder for.
We do this every day.
Yeah, it's daily occurrence here. All righty, guys. Well, that does it for us. About all we got. As always, you can get us on our video feed on YouTube. Just search Know Your Risk Podcast. Go to knowyourriskpodcast.com, bulwarkcapitalmanagement.com. You guys know the drill. And remember, valuations, study your valuations. It's not just about what it returned. Did you just remember what you were going to say?
I did. If you want to,
let's do it. Yeah. Let's do it.
So he's talking about. There's a lot of people are excited about banks because of the deregulation that they're getting, which is perfectly good reason to be bullish. But one of the points he was making was, you may get into a scenario where you're so inflationary. One of the only things you can do, because currently the Fed pays all the banks money for their excess reserves, so they make a bunch of interest for doing nothing. And so his point was like, hey, you want to slow down, creating money? That's one of the ways to do it. It's like you no longer not charge, but just make it flat. Like you have to park at least X% of your money with us, and you get nothing for it. And that really reduces kind of the money supply growth, if nothing else. I never thought of that, but it's a way to, it's financial repression of banks in order to help the economy.
Yeah, and I think it's going to be tough for people to wrap their heads around, because everything you have heard regarding economic policy for the last 15 years has been the opposite of that.
Right.
It's all been about stimulus and easing and more liquidity and all that kind of stuff. And when you're trying to get the toothpaste back in the tube, it's always harder, but there's only one way to do it. It's to do the opposite of that stuff.
And that's why I don't like banks and everyone invests in banks, because I know at some point they become like the sacrificial lamb for policy. Like you look around, like, what button do we have to push? And you're like, oh, look at those banks over there. We can push some of their buttons.
Well, and they're going to, in my opinion, they're going to mandate that banks load up on treasuries and stuff like that before they make individual investors.
We're going to make them buy a bunch of treasuries, and we're going to stop paying them interest on excess reserves. Like we're just going to ruin their income statement from every angle at some point. Now we're going to have to do that to the regular citizens too, but we're definitely coming for the banks. That'll be way more popular than doing it to grandma.
And they did it to themselves. The banks did it for, they did it to themselves.
They're happy to eat at the trough whenever it's good for them.
Yep. They just don't want anybody. Nobody can make any rules about when they got to be done at the trough.
Yeah, exactly.
Despite the fact it's not their trough. But anyway. All righty, pal. Well, that does it for us today, you guys. Like I said, catch us on social media, on TikTok, which I've never even been to our site on TikTok. I don't
have a TikTok account, but yeah, I'm sure it's great.
Yeah, I think my daughter and her friends love it. I don't even let her get on TikTok, actually. But yeah, on all the stuff, YouTube, you guys know where to find us. Got some great interviews. Speaking of which, we got Brent dialed up. He's coming up here, I think, beginning of next week.
Nice.
Yep, that'll be a fun one. Brent Johnson, the dollar milkshake. Perfect timing, too. $1 under 100. I want to see what Brent's long-term thoughts are.
Yeah, ask him about the empty milkshake cup,
Yeah. Well, it's going to be fun talking to him, because I have never seen a guy take more heat from more people that have no idea what he's talking about.
And he just keeps engaging with everyone and explaining it over and over, and the guy's patience of Job.
Well, and then it's always the hard money guys too, right? It's always the gold guys, and yet the first line in his byline is, if you believe, if you believe in math, buy gold, something like that. It's like, no, you got, he and I laughed I remember the first time I interviewed him, is like, they're all dollar bears, and I get it, because I came from that church. But the ultimate evolution of a dollar bear was to realize that, for a while anyway, and I think we might be through that period of time, but the ultimate evolution of a dollar bear was to realize the dollar is going to go up. Just structural.
And that still may be intact. So it is going to be fun to talk to him about the mechanics of it. So
yeah, boy, it'd be hard to see it with our deficits. I think that we got to go, and I don't want to state, but I don't think people are concerned enough, and I don't think we're paying enough attention that non-recession, we're going up to $2.5 trillion. And I'm not dunking on Trump. This has been going on since Obama. Even before. But you're getting to a point now, guys, where, right, I don't think people are paying attention to the numbers, right? Meaning,
that was Calamiras's point, is no one's doing the arithmetic.
No. And they're not realizing that if you keep growing something at this rate and the underlying economy is not matching that rate, you have a problem not very far down the road, guys. If you just continue on this path, I'd have to go look at the numbers, but if you continue on this path, I got to believe in 5 years, you're at 10% plus deficits.
Yeah. That's not how they have it mapped out and scored right now.
Well, yeah, but then let's go back and ask how many times have the CBO projections been correct?
Yeah, if the bond market riots and the interest expense alone becomes just unreal. So,
well, if I go back to the CBO estimates from the early 2000s,
what a joke, right?
We've got 14 trillion in debt right now, so there's nothing to be worried about. Right. I mean, so when has that ever been right? You know, and yet
they never model in a recession or anything either. So
ever. And then they all stand up there like it's this gold certificate of truth, right? Like we won. Like I said, DC is the only place where you get credit for trimming the budget 10 years before it happened.
Yeah.
Anyway, it's the increase in knowledge is the increase in sorrow. I wish there were days I just didn't know this stuff, you know? All righty, man. Does it for us today. You guys have a wonderful evening. Remember, keep an eye on those valuations. It's not cheap because it's a lower dollar amount. You got to understand what you're paying for something, guys. Anyway, have a great evening. We'll see you tomorrow. You're listening to Know Your Risk Radio, or the Know Your Risk podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.